Hello guys, welcome back to my channel Crypto Talks with Arnav. Today we are going to talk about what is finance charge. What is a finance charge? A finance charge is a fee charged for the use of credit or the extension of existing credit. It may be a flat fee or a percentage of borrowings, with percentage based finance charges being the most common. A finance charge is often an aggregated cost, including the cost of carrying debt along with any related transaction fees, account maintenance fees, or late fees charged by the lender. Understanding finance charges. Finance charges allow lenders to make a profit on the use of their money. Finance charges for commoditized credit services such as car loans, mortgages, and credit cards have known ranges and depend on the credit worthiness of the person looking to borrow. Regulations existing in many countries that limit the maximum finance charge assessed on a given type of credit, but many of the limits still allow for predatory lending practices where finance charges can amount to 25% or more annually. Finance charges are a form of compensation to the lender for providing the funds or extending credit to a browser. These charges can include one time fees such as an organization fee on a loan or interest payments, which can amortize on a monthly or daily basis. Finance charges can vary from product to product or lender to lender. There is no single formula for the determination of what interest rate to charge. A customer may qualify for two similar products from two different lenders that come with two different sets of finance charges. Finance charges and interest rates. One of the more common finance charges is the interest rate. This allows the lender to make a profit expressed as a percentage based on the current amount that has been provided to the borrower. Interest rates can vary depending on the type of financing required and the borrower's creditworthiness. Secured financing, which is most often backed by an asset such as a home or a vehicle, often carries lower interest rates than unsecured financing such as credit card. This is most often due to the lower risk associated with a loan backed by an asset. For credit cards, all financial charges are expressed in the currency from which the card is based, including those that can be used internationally, allowing the borrower to complete a transaction in a foreign country currency. Finance charges and regulations. Finance charges are subject to government regulation. The Federal Truth is Lending Act requires that all interest rates, standard fees, and penalty fees must be disclosed to the consumer. Additionally, the Credit Card Accountability, Responsibility, and Disclosure Act of 2009 required a minimum 21-day grace period before interest charges can be assessed on the new purchases. Compete risk free with $1,000 or $100,000 in virtual cash. Put your trading skills to the test with a free stock simulator. Compete with thousands of investor period traders that trade you way to the top. Summit trades in a virtual environment before you start risking your own money. Practice trading strategies so that you are ready to enter the real market. You have had this to need. Try a stock simulator today. The article sources are the Office of the Comptroller of the Currency, Truth in Lending, and Federal Trade Commission. Hmm. What is a financial charge? Definition and example of a financial charge is a finance charge that is any cost you encounter in the process of obtaining credit, using it and repaying the debt. Finance charges using come with any form of credit, whether a credit card, business loan, or mortgage. Any amount you pay beyond the amount you borrowed is a financial charge. Credit cards are the most common way that consumers obtain credit card. One of the perks of having a credit card is that you can borrow money without paying off your balance in full every month. However, taking your time to repay your debt comes at a price. Your card issuer will charge interest on any balance you don't pay off by the end of the month. The interest cost is a financial charge. If you miss a minimum payment deadlines that trails outside of a grace period, your credit card might have you could have charged late payment fee, which is another example of a finance charge. How does a finance charge work? Finance charges are calculated each billing cycle based on the current prime rate, which banks have charged their most credit-worthy customers. This rate fluctuates in response to market conditions and Federal Reserve monetary policy. So any finance charges could vary monthly if your rate isn't fixed. If you have a fixed rate loan, the finance charges is less likely to vary, though if may still fluctuate based on factors such as your payment history and timelines. Creditors have different methods for determining finance charges. For example, credit card issues may calculate finance charges using a daily balance, an average of your daily balance, the balance at the beginning or end of the month, or your balance after payments have been applied. Your credit card agreement may also include a minimum finance charge that can be applied anytime a balance is subject to a fee. For example, your credit card's terms may include a $1 minimum finance charge. So if a billing cycle's charges are $0.65, it will be rounded up to $1. You can reduce the amount of interest you pay by reducing your balance. Requesting a lower interest rate or moving your balance to a credit card with a lower interest rate, you can avoid finance charges on credit card accounts altogether by paying your entire balance before the grace period ends each month. Finding charges on a bill. Finance charges can be listed in several places on your monthly credit card billing statement. On the first page of your billing statement, you will see an account summary listing your balance, payments, credit purchases, and any interest charges. In the breakout of transactions made on your account during the billing cycle, you will see a line item for your finance charge and the date it was assessed. In a separate section that breaks down your interest charges, you will see a list of your finance charges by the type of balance you're carrying. For example, if you have a purchase balance and a transfer balance, you will see details of the finance charge for each different types of transactions, and the balances may come in with different interest rates and grace periods. Paying off finance charges, making your minimum credit card payment is usually enough to cover your financial charges plus a small percentage of the balance. However, if you're only paying the minimum payments, your balance won't decrease by that much. It takes the bulk of a monthly payment to cover interest charges since your balance isn't decreasing significantly. You will face another interest charge during the best billing cycle. Therefore, you will need to increase your minimum payment if you want to pay off your balance and avoid finance charges. So, this is it for today, guys, for what is finance charge. I will see you in the next video. Stay tuned. Thanks for watching.